QuickBooks Chapter 5 is dealing with inventories. There are two ways of keeping records of inventory, and we may not be familiar with it because we have not done inventories before, but I want to go over these two things and see if we can try to understand what they are. The first one is called the periodic inventory system. The second one is called the perpetual inventory system. We're going to look at perpetual first, and then we'll look at periodic. So, perpetual inventory system consists of merchandise inventory and the cost of goods sold are updated continuously to show the current inventory quantity and value. So, periodic, everything is real time. It is updated continuously. You will always know your current inventory quantity. You will always know the value. When inventory is purchased, the inventory count is increased, and when an inventory is sold, the inventory count is reduced. Again, this is perpetual inventory system. Periodic inventory system, merchandise inventory and costs and goods sold are not updated continuously. So, as you can see, which one is probably more popular is perpetual one. Instead, purchases are recorded in purchases account, and each sales transaction is recorded via a single journal entry. Thus, cost of goods sold account does not exist during the accounting period. It is determined at the end of the accounting period via a closing entry. So you can see that the periodic is a little bit more complicated, and perpetual makes it a little bit more easier to control your inventory. Let's find out what QuickBooks uses. Okay, QuickBooks actually uses perpetual inventory system. Why? Because it allows the user to know the current inventory quantity and the value at any given moment. In addition to that, it also calculates the cost of goods sold and the gross profit after each sale without the need of a periodic physical inventory count. So you can see the perpetual is easier to maintain. I think people understand it better. It gives you real time. And if you have ever gone into Best Buy, go into a store and you can ask them if they have this product in the store, meaning in their inventory in that store, they can tell you, they can look it up and go, we got one, or no, we don't have any. And that's because they're using the perpetual inventory system. So when we deal with inventory, we have to start off with what they call inventory items. So inventory items are just that, the items that you have in your inventory. So it depends on the type of business that you have. What can you do with the inventory items? Well, you can delete inventory items, okay? You can select them in an inventory item list, click the item menu button, and then delete them. And you're actually going to go through this process in Chapter 5. These are going to be your exercises. Inventory items are recorded in what we call the list centers. Okay, an item list in all inventory or service items sold by the company. And if items sold as an inventory product, QuickBooks calls this an inventory part or service item. So inventory part, if it's sold, it's an inventory part. Or if it's a service item, meaning that you provide a service to someone, like the design lady that we always do in the chapter. She has a design, so she doesn't necessarily sell parts, but she does sell her services. It becomes under that service item. These can be created, deleted, or modified at any given time. Creating inventory items. If an inventory item does not exist, of course, you know what we have to do. We must create the item before we can begin recording any transaction using the item. Just like we did as far as products, invoices. You know, we have a new company, a new client. We can't begin processing that client until we create it. The same thing with inventory item. You can't begin processing that inventory item until you create the actual inventory. And you do this through list, item, list, new. And again, you're going to go through this in chapter 5. They're actually going to go through this, all these exercises with you. Inventory items can be modified or changed. So how do you do it? You select the item, you click the item menu, again, edit, and you make the necessary changes that you need to make, and then you're able to do that. Okay? So that's just chapter 5 really in a nutshell. But let's do this. Let's kind of review from when we talk about invoices, okay, and all those things that we talked about in chapter 2 and chapter 3 and chapter 4. Kind of review it because we can't forget what we already learned. We're just building on it, okay? So let's review. Remember, we did 3 things. For our vendors, we entered the amount, we paid the amount, we wrote checks for bills we received. For our customers, we entered an invoice, we received the payment for the invoice. If they paid immediately, we created what? A sales receipt. And for services and products we provided. Also, when we have money coming in, we have to make a what? Deposit. Okay, let's go back over to vendors because I want to make sure we have to create the vendor. Then we enter, when we sell them something, we have to create a bill. Okay, we enter the bill. They pay a bill. And if they pay us immediately for our goods or our services, we would do what to them? We write a check and then pay when the bills are received. We created, edited, and deleted accounts in our chart of accounts and recorded adjusting journal entries. Remember, we did a depreciation of computers, depreciation of furniture, things of that nature. So we have to keep those things in mind. And again, you have your book to refer back to it if you kind of get lost. But the good thing about it is that we keep building on. It's going to keep making you review all those things that we've already learned. So vendors, we enter a bill, we pay a bill, and again, we write checks. That's dealing with vendors. Enter bills, you can purchase inventory for a company in the enter bills window. So guess what? We're getting stuff from our vendor. You can actually create your inventory from the enter bills window, and they're gonna show you how to do it. You have what they call expense tabs or item tab. Now, if it's a product that you're purchasing, it's gonna be an item tab. But if it's an expense of a service that was rendered, then it's going to be in an expense tab. So you kind of have to know what type of bill is it now before you're going to put your inventory. Because you usually put your inventory when it's items, not an expense. Okay? Also, you write checks. And just like the enter bills window, you can purchase inventory for the company in the write checks window. So if you pay for it or immediately, all at once, you're not going to create a bill for it. You're going to write a check. And again, you're going to go to the item tab, put in the item, put it in the inventory of that item and all that, and it's done in those same locations. And when we did it the first time, we didn't do all that. But then it's going to go back and show you where you can actually do these additional steps. Okay? Sales tax. Now when we start talking about inventory, we got to deal with tax. So every state wants their tax. Every county wants their tax. You see what I'm saying? So you have to keep track of your tax. Taxes are involved when a product is sold to a customer. Sales tax in QuickBooks is automatically added to the invoice price of the product. For example, here, I've given it a product costs $1,000. There's a 6% sales tax. 1,000 times 6% is $60. So the total price of the product is going to be $1,060. So that's just the way how they do it. They're going to get their money, believe me. the sale of inventory. Sales of inventory is recorded in the Create Invoices window when it is on account for 10, 15, 30, 45 days. Remember, from the chapter that we worked with sales, there are three things you do with sales. You create the invoice, you receive payment for the invoice, or if they pay for a service or a product immediately, you enter a sales receipt. Just like before, we're not going to forget all those good things we learned before. When the product you sell is on account, you go to Create Invoice window, you locate the customer, you type in the date, the invoice number, the quantity, the item code, all those things that it's going to be looking for. Okay? Now, when you're dealing with sales, not sales, but cash, when it's done, the other one, this one here, was on account. But when you're dealing with cash, what happens is when the product you sell is paid for immediately, you go to the Enter Sales Receipt. And from that window, you're going to locate the customer. You're going to click Check and enter the check number. You're going to remove the check mark from the Print Later and Email Later. Remove those check marks from there. The tax from the customer's tax code drop-down list should be selected. And you're going to type in the date, the invoice number, the quantity, item, and all those other things that you have. There's one more thing we have to consider when we're dealing with inventory items, and it's called sales discounts. Everybody likes a discount. So sales discounts are offered to customers to encourage early payment of outstanding invoices. Discounts are usually 1% or 2% reduction in invoice amount if the payment is made within a certain period of time. So say, for example, you have a 45-day period. You pay within the first 15 days. They may give you a discount because of that. Okay, there is a discount and a credit button in this area when you see it. And again, in Chapter 5, they're going to show you how to do all these things, which is, I think, is really neat. Because once I went through this, I totally understood discounts that you have at Macy's, you know, the department stores, Kohl's. It gave me a better understanding of that. In addition to just your inventory items, you have what we call the Just Quantity Value on Hand window. It's a window that you use for adjustments. Say, for example, that an item is stolen, or an item is lost, or is damaged, or spoiled. You can adjust it in this called Value on Hand window. It's called a Just Quantity Value on Hand window. This window is used only to record changes in the inventory if the item is not purchased and is not sold. Okay, can't sell it, you can't purchase it, you can't sell it. So this means that something else happened to the item, but it's no fault of yours. So if that's the case, you have to do what they call going to the Adjustment Quantity Value on Hand window. So let's talk about that for a minute. The Adjustment Quantity Value on Hand window is found under the Vendors tab. Okay, Vendors, Inventory Activities, Adjust Value on Hand. That's the process in which you're going to go into. You're going to click on, you're going to get to see what else you do, and then that's where you actually go in and make those changes. Pay sales tax windows. All those sales tax you may have captured for the month, at the end of the month or the end of the quarter, you want to pay your sales tax. Okay, so there is a pay sales tax window, so you can deal just with that particular sales tax. It's used to record the remittance of sales tax charged to customers to the proper tax agency. For example, Texas Department of Revenue, because that's where you do it here in Texas. If you have a product and you sell, you have to pay your taxes. Let's just talk about make deposits. We began making deposits in Chapter 3, as you can remember. Record deposits in the make deposit window. That's what we actually do. So we're still going to do it here in the make deposit window. Okay? But then you have all your inventory reports. And these are used to help keep track and manage inventory. So Some people do inventory once a month.